Imagine a world where every single person wakes up and collectively decides, no more debt payments, no more mortgages, credit card bills, student loans, car payments, nothing. At first, it sounds liberating. People would have extra money in their pockets, no stress over due dates, and no more bank calls reminding them about overdue balances. But here's the catch. The financial system doesn't exist in a vacuum. The moment payments stop, the dominoes start falling. And once they fall, they don't stop. This isn't just a personal decision. It's a thought experiment exploring the economic impact of mass financial rebellion. What happens when the entire system that thrives on debt suddenly collapses? Banks. The first to fall. Banks aren't just buildings with vaults full of cash. They operate on a delicate balance of lending and borrowing. They take money from deposits and loan it out. In return, they collect interest on those loans, making a profit while keeping the system moving. But if millions, no billions, stop paying their loans, that revenue stream dries up overnight. Banks suddenly have no money to lend, no way to fund withdrawals, and no method to sustain their own operations. A global banking crisis erupts almost instantly. In an attempt to survive, banks could take drastic measures like freezing withdrawals to prevent a run on the banks, increasing fees on transactions to make up for lost income, or begging governments for immediate bailouts to stay afloat. The problem is that governments might not be able to help. Stock market collapse and investor panic. With banks failing, financial markets would plunge into chaos. Investors, sensing an economic doomsday, would panic sell stocks, causing markets to plummet. Companies relying on loans would see their stock prices collapse. Retirement funds and pensions, heavily invested in stocks and bonds, would take a massive hit. Wealth would evaporate overnight. And it wouldn't just be banks in trouble. Entire industries would start crumbling under the weight of unpaid debt. The corporate domino effect. Most businesses don't survive on profits alone. They take loans to cover operational costs like paying employees, purchasing inventory, and expanding into new markets. If banks stop lending, businesses stop running. Small businesses would be the first to shut down, as they rely on short-term loans to keep their doors open. Larger corporations would follow, because without credit, they wouldn't be able to fund expansion or even cover payroll. As mass layoffs begin, millions of workers lose their jobs and consumer spending collapses. No jobs mean no money to spend, and as a result, the economy grinds to a halt. Suddenly, people who thought they were winning by skipping debt payments find themselves jobless and unable to afford basic necessities. Meanwhile, landlords who depend on rent payments to cover their mortgages stop receiving income. Their buildings get seized, and renters face eviction. The crisis expands beyond financial institutions and into everyday life. Housing market crisis, the Second Great Depression. Homeowners would initially celebrate, thinking they just got their houses for free. No more mortgage payments would seem like a dream come true. But the reality is far different. Banks and lenders still legally own those properties. If mortgage payments stop, banks might respond by seizing homes at an unprecedented scale. However, foreclosing on millions of properties isn't a solution. It's a disaster. No one would be buying because no one could get a loan. Home values would crash, and entire neighborhoods could become ghost towns. Landlords who were renting out properties with outstanding mortgages would also stop paying, leading to more seizures and evictions. The homeless population would skyrocket. If this sounds familiar, that's because it happened before. The 2008 financial crisis saw a similar scenario, but on a much smaller scale. And that alone caused a global recession. Multiply that by an entire world defaulting at the same time, and you're looking at an economic apocalypse. Governments, too big to fail or too big to save. Governments hold massive debt, borrowing trillions for infrastructure, military, healthcare, and social services. If tax revenues shrink due to unpaid debts, public services collapse, schools close, hospitals shut down, and government employees go unpaid, including police and firefighters. Some nations may default on international loans, shaking global confidence in major currencies. To prevent disaster, governments might print money, risking hyperinflation, or offer debt forgiveness to reset the economy. Others may enforce strict financial controls, seizing assets or freezing accounts. Without a stable financial system, political turmoil follows: riots, revolts, and even regime changes. A shift toward alternative economies. With traditional banking and government-backed currencies failing, people would turn to new ways to trade. Barter systems would resurface, with people exchanging goods and services instead of money. Cryptocurrency adoption could skyrocket as decentralized digital currencies become a more stable alternative. Black markets would thrive as underground economies fill the gap left by collapsing institutions. This transition wouldn't be smooth. Without oversight, alternative systems could be just as chaotic, filled with fraud, scams, and inefficiency. Everyday transactions could become complicated, with no universal system of value. Trading a haircut for groceries sounds simple in theory, but without an agreed-upon standard, commerce could become messy and unpredictable. Could this lead to a new financial system? If the financial rebellion lasted long enough, the world would have no choice but to rebuild from the ground up. Banks might be forced to adopt new, lower-risk lending models. Debt-based economies could shift towards savings-based growth, prioritizing financial stability over rapid expansion. Universal basic income might become necessary as a way to prevent economic collapse. Some governments could introduce new digital currencies with expiration dates to force spending and prevent financial stagnation. But getting to that point would require years, possibly decades, of financial and social upheaval. The transition wouldn't be painless. Some countries might thrive by adapting quickly, while others could fall into long-term economic depression. The idea of a world without debt might sound utopian, but the reality of dismantling the current financial structure could be catastrophic before any meaningful progress is made. The cost of mass financial rebellion. So, what happens if everyone stops paying their debt? At first, relief, then chaos. Banks collapse, businesses fail, and governments struggle to function. The financial system, built on the idea that people will continue making payments, would come to a screeching halt. Public services would disappear, unemployment would soar, and people would be left scrambling to find ways to survive. Long-term, the crisis could force a financial reset, one that challenges the role of debt in modern economies. But for the average person, the consequences of mass default would be far worse than keeping up with monthly payments. While it's fun to imagine a world where debt no longer matters, reality reminds us that the system doesn't break without consequences. For now, paying off that credit card bill might still be the safer bet.